Welcome back to a brand new video. Today we're going to be diving into mortgage rates and whether or not we're going to have Federal Reserve interest rate cuts by the end of this year. There has been an enormous amount of data changes happening. We've seen inflation going up. Unemployment has still remained extremely low despite all the headlines of layoffs that we've seen. So I want to dive into when the next Federal Reserve meetings are, because we have one this month, what the odds of rate cuts are leading into December of this year, and potentially the idea of rate hikes being on the table. About a year ago, the expectation from investors was that we would have 4 to 6 rate cuts in the second half of 2026. And now that we're in June, approaching the second half of the year, we are basically seeing the complete opposite of those expectations. By the way, if you're interested in housing market data across Southern California, check out themarketvector.com in the description below. This is a platform that I have been building over the last few months, and I really built it to track every single metric possible across the housing market. I'm a realtor here in Southern California, and I really had an issue with lack of data being available. So that's why I built this myself. It tracks every metric you can think of, including investor metrics, cash purchases, investors buying in different cities, demand rate, market absorption, basically everything you can think of. And foreclosures are also coming soon this month. So check out the market vector in the description below. Let's get straight into the video. So as of right now, mortgage rates are around 6.5%, and they have kind of been here for, you can really see going back to May-ish of last year, 6.5%. And unfortunately, I don't really see this changing anytime soon. So the Federal Reserve, the Fed funds rate is between 3.5 and 3.75%. And on this platform, I'm tracking the rate cut odds, and this has pretty much been 100% accurate. When you lead up to a meeting, obviously data changes leading up to the meeting, but whatever the odds are in that meeting, historically, 99% of the time, the Fed is going to do what the odds are anticipating. And the next meeting you can see here is June 17th, and the odds of what they're going to do is hold interest rates with a 99% chance. Now, what is kind of scary to me is you can see leading into the end of the year, you see July, September, October, December, and even January in 2027, there's no rate cuts on the table whatsoever. In fact, once you get to December of this year, the odds of having a rate hike is actually higher than the Fed holding rates steady, which is very, very scary. Now, I would like to preface this by, just because the Federal Reserve cuts interest rates or raises interest rates, it doesn't necessarily mean it's going to have an impact on mortgage rates. Now, I want to prove this to you by pointing out 2024. In 2024, the Federal Reserve cut interest rates by a full percentage point. So the Federal Reserve funds rate dropped by 1%. And we saw mortgage rates go from 6% to 7%. And this basically happened because right as the Fed cut rates, inflation came back and the unemployment rate dropped. So all of a sudden, everyone said, why did you cut rates if inflation is coming back and the unemployment rate is still at historic lows? And what caused mortgage rates to go up is actually the 10-year Treasury yield. The 30-year fixed mortgage essentially just tracks the 10-year Treasury yield, and that fluctuates depending on a lot of things, but the primary factors are economic data such as inflation, the job market, unemployment rate, and interest rate cut odds. So if all of a sudden tomorrow the new chairman of the Federal Reserve, he might be in right now, I'm not 100% sure, if he said, you know what, we are cutting rates by a full percentage point next week, that shock would in turn drop mortgage rates because it's a surprise. The market hasn't expected this. The market hasn't priced this in. Mortgage rates, the 10-year Treasury move on what the market is pricing in. And it's really 6 to 12 months. The market looks forward 6 to 12 months. So that's why I've put the next 6 Federal Reserve interest rate cut meetings, interest rate decision meetings on my platform here. So anyway, once we start to get into really September, the odds of rate hikes start to increase. You can see there's a 27% chance that the Fed is actually going to raise interest rates by September of this year. So because we are starting to see rate hike odds increasing due to inflation coming back, inflation's up almost 1% month over month because of the oil shock that we've had. A barrel of oil has gone from $70 to over $100. Now, at the time of making this video, I think it's back to $90 a barrel. Ideally, we get this conflict resolved and oil goes back to its $70, $75 a barrel range. And that in turn should ease inflation expectations, because right now, with inflation jumping 1% month over month, the market, investors, everyone is kind of anticipating that's just going to carry on going up because the cost of a barrel of oil has remained elevated for quite some time. So all of this is impacting Fed meeting probabilities, and starting to see rate hikes on the table is actually quite terrifying for mortgage rates, because if we get to October, December, inflation is still where it's at, the unemployment rate is still relatively low. I'll talk about that in just a minute. Then if rate hikes do in fact become an increased probability, meaning the Fed is swaying toward hiking rates to combat inflation, mortgage rates are probably going to be back above 7% before we know it. And obviously this could happen sooner rather than later if inflation continues on going up and if the unemployment rate remains low. Now, inflation is of course a major factor that the Fed looks at, but the unemployment rate is another huge factor that they are trying to navigate with this rate cutting, rate hiking scenario that we're in right now. One of the Fed's main mandates is to maintain job stability, but they don't want the unemployment rate to be too low, because if everyone has a job, inflation is 100% going to go up more than they want, because more people are making money, and that in turn leads to more people spending money. So in an ideal scenario, the unemployment rate actually trends up into the second half of this year, into the first half of 2027, back to its historical average, which is between 5.6 and 5.8%. If you look back to the last 50 years of data, the historical unemployment average is around 5.6 to 5.8%. And where we are right now is around 4.3%. So we are well below the historical average. So if we got this trend back to where it typically sat in the last 50 years, then the Fed could potentially have rate cuts on the table again in 2027. I know the unemployment rate going up 1.5% is probably a little scary to some people, but that has been the historical average. Right now, with 4.3% unemployment and inflation going up, I'm really not surprised that rate hike odds are actually going back on the table. So mortgage rates, if we look back to the 30 years of data, we are actually, getting to where we were in 2000, 2005. In 1998, we were around 6.6%. So we're kind of back to those average levels, but the issue is that home values have increased substantially over the last 6 years. So where does that lead the housing market? Well, if we look on this map here, you can see a lot of it is in red. So that is low demand, green is high demand, and mortgage rates, of course, play a factor into this, play a factor into affordability. And cities that have increased 20, 25% over the last 4 years, when rates were 2.5%, 2%, all of a sudden they're dealing with the home values have increased even more. Mortgage rates have almost tripled in some cases, and now there is a little bit of an affordability issue. But that hasn't really scared off cash buyers at all, because they are still coming in full steam ahead. You can see a place like Newport Beach, which has a median sales price of $3.3 million. Almost 37% of all transactions are purchased with cash. So wealthy areas are probably not going to be impacted at all in terms of home values. But places where there are fewer cash purchases, let's take a look at Riverside. 16% of the market is purchased in cash. That tells me that not too many investors are probably purchasing here. Yep. So 11.5% of this market are being purchased by investors, which is relatively low. So mortgage rates remaining elevated are probably going to impact the cities, the locations where fewer and fewer cash purchases are happening. It's more families, it's more younger people buying their first home, first-time home buyers, people looking to, just get out of that rental cycle. Those are the people that are likely going to be impacted the most with mortgage rates remaining elevated. So we talked about what needs to happen for rates to go down, and the scenario where rates carry on going up, unfortunately, is on the table right now. If you like this video, subscribe for more. Check out themarketvector.com, linked in the description below. Data tracking all across Southern California. I look forward to seeing you in my next video.